Let's talk a lot about, I want us to focus on flour mills today because that company has come out with a bond issue program of 70 billion naira in all, starting with 35 billion. But the first thing that attracts my attention with that company is that the second half is projected to be weaker because we've seen pretty strong growth on the top line and the bottom line in the first half, but going into 2011, I think it must be the story about the rising flour prices that is hitting them.
Definitely, that is a key consideration for flour mills, because if you look at if you track wheat prices, say in the last couple of months, we've seen close to a 60% rise from say June to date. So obviously, and I'm thinking that probably flour mills did not hedge enough on most of these commodities, so I think it's going to tell on the second half numbers going forward.
I think there's obviously an extent to which they can pass on these rising prices to consumers. But let's talk about their cement business, because really flour mills is a conglomerate, even though it is called flour mills.
Yes.
And they've invested quite a bit in cement. They are major cement importers, possibly top 2 cement importers in Nigeria right now. And of course, we know they're also investing in, they've also already invested rather in a cement producer. But how do you see the changing dynamics in the cement industry, more so with likes of Dangote Cement coming on board and increasing capacity? How do you see that impacting on their cement business, particularly when you consider that government is likely to change its policy stance on that point?
Basically, the cement business in Nigeria is more like a regional play. So companies are strongest around their regions. Flour mills is located in the southeastern part of Nigeria. The cement plant Unisem, which is in a tripartite arrangement with Holcim and Lafarge. And so you would expect that each of these companies would have very strong market shares in their sections. But like you've said, with Dangote coming on stream, expanding aggressively, is currently the largest player in the cement market. Obviously, at some point, as cement demand, or rather cement supply begins to meet up with demand, you would see that would begin to have some encroachment into other player regions by a large player like Dangote.
Well, really, what is driving the conservatism? Because I've seen the forecast that the company put out when they came out with this bond issue, and they're projecting really moderate growth over the next 5 years. I think a compounded rate of about 5% in terms of profits. Why are they so conservative? Because one would have thought that expanding is really a bet on the market potential. But if you're expanding and you're only getting 5% growth, does that suggest that the market is saturated?
Well, one thing you would notice with companies, they tend to be a lot more conservative in their forecast. So when they surpass this forecast, the market sees that they've done well. Looking at flour mills across all the business lines, you would expect that a lot of diversification is going on in our interactions with them. They plan to, really explore the consumer food market a lot more. We hear that they're going to be they're investing part of the proceeds in the bonds is going to be used to complete the sugar plant that they're building, a 750 million metric ton sugar plant. But obviously, we don't expect to see some of these investments coming on until the next 2 years. So what you would likely see is a little bit of conservative forecasting by the company, but if you ask me, I think they should be able to beat those forecasts.
And then coming back to the bond issue itself, the guidance they are providing for the bond coupon is between 10 and 12%, whereas we have the 3-year bonds at 11%. To me, it's sounding somewhat aggressive. Or is it more a factor of the structure of these bonds? Because it's not your regular bond where you have principals paid at the very end. They are planning to start paying back principal after 3 years.
After 2 years.
Was it after 2 years? Okay.
Yes. They have a 24-month moratorium on the principal repayment. So what you will see, between years 2 and 4, they'll pay back 50% of the principal, and on year 5, they retire the whole obligation. So if you look at it, some people tend to see it as a 3-year instrument because you really actually start to receive your principal from year 2. So I guess when you look at it on that bit, it is it gives some sense that yes, we are not actually looking at a 5-year paper, so do not compare exactly with the 5-year. But if we look at the federal government securities, a 3-year is hovering well over 10%. So I'm thinking, obviously, we should expect to see some spread between the sovereign notes and corporate notes. So my thinking is that a lot of investors are going to be pushing for yields higher than the 12%.
Right. I mean, we have to wrap up now, but very quickly, how do you see this impacting on your rating of the stock? Flour Mills is one stock I think Vetiva obviously likes. What's your rating of Vetiva?
Yeah, we're still overweight on Flour Mills. The valuations are looking good. It's currently trading at 7 times PE compared to a market average, to a sector average of about 11 times, and this market average of 16 times. So a lot of value still in for Flour Mills. The diversification we think is a good story. Consumer business really is a business for a market like Nigeria, so you really want to be in that sphere. So on the back of all of that, I think Flour Mills is a great buy.